This is Nick here for Merk Research, and I'm about to go through some of the highlights from our U.S. equity chart book. I'll cover the same charts as last time with some additional charts, and for primer on the old charts, you can look at the initial U.S. equity market presentation, which is on the playlist there, or read the framework sections in the written PDF version that is posted on the Patreon page. So before I dive into the charts, let me say that the investing audience should view this in the context of their individual investment process, time horizon, and goals. Our objective in reviewing these charts is to keep our eyes open to what's going on out there, and in sharing it with you, we hope to add value to your own thinking on the markets. So let me start with this chart, which is it's the same chart that I started with last time. There's no update on this chart. As the data is released only quarterly, the next update will be in late March. This comes from the Fed's Z1 report. But to reiterate, my opinion on this chart suggests that annualized returns over the next 10 years might be below average if history is any guide. So currently I'm negative on this picture and on the outlook for stocks over the 10-year horizon. What would get me positive is to see the equity allocation proxy, this dotted gray line here, move to reflect a 30% allocation or lower. So this is an inverted axis here, and if we saw that that dotted gray line move through that 30 level, that would get me positive on this picture. That would most likely only happen after a substantial bear market in stocks, but in any case, an allocation reading above this level might suggest that subsequent 10-year annualized returns could be above average for the S&P 500. All right, so that last chart is more of a long-term chart, and I'll focus on more near-term indicators pretty much for the rest of the presentation. This here shows the business cycle. The U.S. business cycle continues to look very strong. So for its part, the business cycle doesn't appear to be a headwind for the stock market. If anything, it's neutral to positive in my view. Now, there's been a recent drawdown in the S&P 500. You can see that here on the right. I'd be more concerned about that being the initial phase of a bigger bear market if the LEIs looked like they were rolling over, which they don't for the time being. So my current characterization of this chart is generally positive. What would get me cautious is to see the LEIs roll over as the S&P makes new all-time highs. Now, we might not get that setup. That setup is basically what we saw in the last cycle, where the LEIs rolled over and the market continued to make new bull market highs. We will not necessarily get that setup, but if we were to see that situation where the LEIs roll over as the market continues higher, that would get me cautious on this picture. All we can say at this point is that the business cycle, in my view, doesn't look like it is a negative for stocks. The global growth backdrop has softened somewhat since last month with the latest releases of manufacturing PMIs. Here we have the largest four economies in the world. So Germany here ticked down, the U.S. ticked down, Japan's manufacturing PMIs ticked up, and China's ticked down. So we had three out of the four tick down, which is a relative change for the worse, but in absolute terms, still all four are above the 50 level. And so generally my characterization is still positive on this chart. What would get me negative is to see any of these four fall below this 50 level. Let's now look at the U.S. financial conditions. So financial conditions have tightened somewhat recently. This is the Chicago Fed National Financial Conditions Index. On this latest reading is through the week of February 2nd, so it doesn't include the most recent week, which is through February 9th, and that will most likely show a further deterioration in financial conditions. But this index, the Chicago Fed National Financial Conditions Index, has about 100 sub-indicators and provides a very comprehensive look at what's going on with financial conditions broadly. So it's not just what's happening in the stock market. That's a very small part of this index, and it's one of the things that I like about it. So still have a positive characterization on this chart. What would get me negative as I said last time, is to see financial conditions deteriorate through this negative 0.50 level. All right, let me talk a little bit about market breadth. So, as I mentioned last time, breadth analysis is generally oriented towards trying to see warnings at major market tops. And the way that I look at breadth is to take readings at new bull market highs. So the last high that we had, bull market high that we had in the S&P 500 was on January 26th. The percent of stocks above their 200-day moving averages was 83%. So that's well above the warning level of 65% that I have set for my framework. That's the dotted black line here. And not a level that I would associate with a warning on a major market top. So my characterization is still positive on this chart. What would get me negative is to see the S&P 500 making new bull market highs with the breadth, with this reading below 65%. Now, there are several ways of looking at breadth, as I mentioned last time, and because I think it's relevant right now in the context of the current drawdown in the equity market, I'm going to show another way of looking at breadth that puts things into more of a historical context. So this is a breadth table that shows 15 major market tops over the past 90 years in the Dow Jones Industrial Average, using that as the index. And at each market top, it takes two readings. So the left column here shows the percent of Dow Jones Industrial Average component stocks that are within 2% of their bull market highs. And then the right column shows the percent of Dow Jones Industrial Average component stocks that are down more than 20% from their respective bull market highs. Now these measurements are only taken at historical major market tops. And what you can see is that historically at these major tops there's generally been relatively low participation in this left-hand column, so relatively few number of stocks in the index that are within 2% of their bull market highs, and then relatively high participation in this right-hand column with more and more stocks being more than 20% off of their bull market highs. The last high that we had in the Dow Jones Industrial Average was January 26th. I took the measurements. 63% of the component stocks were within 2% of their bull market highs. Only 7% of stocks were more than 20% below their bull market highs. So that is, in my view, suggestive of strong breadth, not weak breadth, and is inconsistent with the historical pattern of major market tops as I interpret it. So my thinking is that on balance, it seems more likely than not that the U.S. Broad equity indexes, the Dow Jones Industrial Average and the S&P 500, will make a new all-time high prior to the next bear market. Now, the term bear market is not that well defined, so for the purposes of clarity, I'll define it as, in the way I'm using it here, to mean a 25% drawdown or more over a 6-month or longer period. So my current characterization on this table is generally positive. What would get me cautious is to see this reading here in the left-hand column below 30% at a new bull market high in the Dow. Let me show this chart, which just marks the 15 major market tops shown on the previous table, so that you can get a visual sense of what those major market tops look like on the chart. All right, then turning to the sentiment picture. So this is a chart that was shown last time. It's the AAII survey of bulls as a percentage of those who identified as either bulls or bears. And that reading has come down to 51%. So that is below the long-term average of 57%. It's about half a standard deviation below that long-term average. So sentiment has come down somewhat with the market recently, which is what you would expect to see. I would characterize this as a neutral interpretation. For me, what would get me positive on this chart is to see readings below 44%, and what would get me negative is seeing readings back above 57%. From a contrarian standpoint, what you want to see is basically very weak sentiment if you're looking to be on the long side of a market. All right, so let me turn now to a chart that I didn't show last time, so let me introduce it here. This chart shows margin debt, which is the gray line, and the S&P 500 index, that's the black line in the top panel. And then in the bottom panel, it shows the ratio of margin debt to the S&P 500 in terms of its year-over-year rate of change. So while margin debt has risen over the past few years and in general during this bull market, it has not risen relative to the market. And what you can see is that in the past, when we've had market tops, if you go back to 1999, you saw a buildup in margin debt relative to the market. And you can see that expressed here in this year-over-year rate of change exceeding 40%. And then similarly in mid-2007, you saw this buildup of margin debt relative to the market, and that exceeded 40% there. So currently, we do not see that similar picture of buildup in margin debt relative to the market. So as far as this chart is concerned, it's not specifically an area of caution for me. What would get me cautious is to see that margin debt build up relative to the market. All right, let me turn now to a chart that we look at internally that I want to introduce because I think this framework is worth sharing. What we're looking at is the 2-year average rolling correlation of the 10 sectors to the S&P 500 index. That's the black line. And then the 1-year realized volatility, the average 1-year realized volatility of the 10 sectors. And generally speaking, from a conventional thought process on portfolio risk management, portfolios are going to look less risky when correlations are low and volatility is low. And just as a sort of reminder on what those terms mean, I think the simplest way to think about it is that volatility represents the movement of an asset relative to itself, and correlation represents the movement of an asset relative to other assets. And so when both the volatility of the individual assets in your portfolio are low and the correlations between those assets are low, your measured portfolio risk, judged by the portfolio standard deviation, is going to be low. And so from a conventional standpoint, stocks look low risk, quote unquote, when both volatility and correlation are low, which is generally the environment that we're in. If you look at this chart going back to 1993, we're generally at the low end of the range in terms of the correlations of the sectors to the index and in terms of the volatility of those sectors themselves. And so paradoxically, as portfolio risk looks low, that's actually, from a contrarian standpoint, in my view, a time to be somewhat concerned on a medium-term outlook time frame. So you can see here in the last cycle, actually correlations and volatility bottomed before the market topped. They bottomed in basically early 2007. And then in late 08, early 09, both correlations and volatility were very high. And so that's an environment where you really had indiscriminate selling of assets. And so measured portfolio volatility or measured portfolio risk is going to look very high in this environment of late 2008 and early 2009. And as I said, somewhat paradoxically, that's actually, I think, an attractive time for a long-term investor to start investing into asset markets, or in this case, into the stock market, given that portfolios have gone from appearing low risk to appearing high risk, and that's created a highly motivated selling environment, you could say, for stocks. So generally, from a contrarian standpoint, you want to look to deploy capital when the environment looks extremely risky, and look to take chips off the table, if I can use that expression, when risk looks very low. So basically, we've seen the volatility and correlation tick higher here with the current drawdown. But this is something that I still think generally we're at low levels on both, and that this represents a medium-term risk for the equity market. So this is something that we will be keeping an eye on. What would get me Positive, I guess I could say that my current characterization on this is generally cautious to negative. What would get me positive is seeing the correlation and volatility at higher levels, let's say above 25 on the gray line here on the volatility, and above 0.8 on the correlation, which would be up at this level. And that would likely only occur after a big bear market in stocks. This is a very simple diagram to help visualize how low volatility and correlations relate to the conventional concept of portfolio risk. So, as I said, volatility measures basically the movement of an asset relative to itself, whereas correlation measures the movement of an asset relative to other assets. So, in your portfolio, when you have assets that are low volatility and that have low correlation to each other, that's going to look like a low risk portfolio, quote unquote, based on that kind of standard framework, conventional framework. And then conversely, when correlations are high and when volatility is high, that's going to look like a high risk portfolio. And as I said, my framework from a contrarian standpoint would be to look to go from cash into assets when asset markets look like they are high risk, and conversely go from assets into cash when asset markets look like they are low risk. And that's basically just based on the principle that you want to be thinking differently from the herd. All right, here's another chart that I didn't show last time. This chart shows the U.S. Economic Policy Uncertainty Index. That's the gray line here. That's on an inverted axis, so higher readings on this gray line represent lower levels of uncertainty. And then the S&P 500 index is the black line. So you may have heard the expression, a bull market climbs a wall of worry. And this is one way, I think, of visualizing or indexing that wall of worry, basically. Right now, uncertainty, the reading is at 95, so it's moderately low, but not at the very, very low levels. And what you can see here in the past is that near market tops, in fact, even during the market top of 2015, before that corrective period of mid-2015 to mid-2016, the measured uncertainty was very low, below that 50 line that I have dotted here. The major market top back in 2007 was at a time when uncertainty was extremely low, and then similarly in 99 and 2000. And so basically the framework here is that if you see uncertainty extremely low, that might suggest that the market's fully priced, that there's no longer any more worry, that there's no longer a wall of worry for the market to climb. So I'd characterize my view on this as being neutral to positive. Basically, it doesn't look like the uncertainty index is at the warning level that I've put there, which is 50. What would get me negative is seeing that uncertainty index basically fall below that 50 line or rise on the chart here. All right, another chart that I didn't show last time, and I'll probably just share this on a selective basis, but I think it's relevant to the current drawdown in the equity market. What this chart shows is the steepness of the VIX forward curve. That's represented in this case by the 3-month futures VIX index minus the spot VIX index, and that's the gray area. So when that curve is a normal shape, this gray area is going to be above the zero line, and when it's inverted, this gray area is going to be below the zero line, meaning that the 30-day VIX index or the spot VIX index is higher than what the futures market is pricing the VIX index to be in 3 months' time. And what you can see is that historically this has been somewhat of an indicator of the end of corrective phases. So even going back to the bear market of late 08 that ended in 09, you can see as this VIX curve normalizes, that can be somewhat of a signal that the stress is out of the market. Now you do get some head fakes here where this can be, this line itself can be volatile and jumping back and forth across this zero line. But given that we're well negative on this, and I'm recording it after the close on February 9th, I would say that in my interpretation, this correction is very much still in play, meaning we could see new lows in the current drawdown that we're in right now. All right, so let me provide my summary and conclusion. Basically, I'm still negative on the 10-year outlook on stocks from current levels, but near term, generally still constructive. The business cycle looks strong. The global growth backdrop still looks solid. Financial conditions still look supportive of stocks. The market breadth picture at the last high was strong enough for me to think that it doesn't look like that represents a major market top. The market sentiment has come down, which is a positive. Investor leverage, that's the margin debt chart, doesn't look stretched. In other words, it doesn't look like it did in 99 or 2007. The correlation and volatility picture does look negative to me over the medium term, let's say 5-year outlook or so. Then the uncertainty backdrop suggests that the market still has some wall of worry to potentially climb. But in the very short term, as I showed on that VIX chart, I think that the drawdown that we're in. Let me talk a little bit about some kind of conventional fundamental metrics. So right now, the S&P 500 as of the last close is right around 2620. That's very near where it was on December 1st. I think December 1st was right around 2640. Meanwhile, in terms of the forecast earnings per share growth for the calendar year of 2018, and this is according to FactSet, the forecast growth for earnings per share for the S&P 500 for the calendar year of this year, 2018, has gone up from 11.1% on December 1st to 18.5% on February 9th. And the 2018 revenue growth forecast has gone from 5.4% on December 1st to 6.5% on February 9th. Then the 12-month forward price to earnings multiple has gone from 18.3 on December 1st to 16.3 today. So that's 2 full points of multiple contraction. So by conventional standards, the fundamentals and valuations have improved, I would say, to a notable degree, just going by those numbers. And again, those are very conventional ways of thinking about the markets. My base case scenario, for what it's worth, remains that this is a correction in an ongoing bull market. Although, as I said, I think near term this correction is still in play. Possible that we have further lows ahead. And then let me just reiterate that, for the investing audience, this should be taken in the context of your individual process and time horizon and goals.